Everyone needs a cell phone. Everyone needs access to the internet. And somehow AT&T was down 10% in one day off of earnings. I think this is something we have to be concerned about. And we have to be concerned about the macroeconomic forces. The market has had a tremendous run. We talked about three important levels yesterday for all three indices. The S&P 500 closed right below, you just basically kissed it, the 4,000. After today's earnings with Snapchat, I don't know if that's going to happen, but we're going to get to Snapchat in a second. First, I want to focus on AT&T. I owned AT&T a few days ago. I was concerned this was going to happen. I sold the stock. I'm surprised it happened. I'm genuinely surprised it happened. My selling it doesn't mean I'm not surprised, but I'm surprised. What it means is people are struggling to pay their necessary bills. They're struggling to pay for their phone. And this is something everyone needs. You know, this is not really a discretionary item. This is like making your car payment, making your house. These are big deals, big things. People pay their phone. They don't want to lose access to their phone. And that is happening. So I think if people are not paying their phone bill, we have to extrapolate to other areas of the economy. And something we're focused particularly on, we've talked about in other videos, is Apple. It just so happens that paying your phone bill, what's up, Zach? I saw that before, but I'm just kind of going with the flow here. Just so happens to be that Apple and phone bills are very much connected, very same segment of consumption. My assumption is that we've seen Apple pre-owned prices come down. We've seen people struggle to pay their AT&T bills. My assumption is we're going to see Apple have a similar situation to AT&T. And guess what? Apple is 7% of the S&P 500. Facebook is another company that's quite large. We're seeing what's happening with Snapchat right now. That leaves us Microsoft, which is giving us this little touch thing about Forex. Google, which also relies heavily on advertisement. We'll see what happens there. So, I am concerned about the mega caps. What do you think about the iron miners? They are at very interesting prices. BHP, Rio. So I actually have Rio. I have owned BHP in the past. Sold BHP at the highs just to take some gains off the table. Wouldn't be afraid to enter it again. I heard someone today say, I think it was the Freeport McMoran CEO, say that there was a disconnect between the actual demand and consumption for copper and where the market's at. And it's a very volatile time in the copper market right now. So I've seen this happen with oil. You saw it happen with oil when we were at negative $37 a barrel oil in 2020. There are paper traders involved in these commodity markets. It's not a perfect market. It should be, in my opinion, just people that are consuming the product and people that are producing the product, creating a market. However, that's not the case. So I think these companies are well priced. I like Cleveland Cliffs. I believe they're reporting earnings right now. Maybe they're moving. I like Rio. Rio's very well diversified in iron and various other materials. Uranium, gold as well, I believe diamonds. Very interesting company. Big dividend as well, as BHP you mentioned. My point here is, I think the stocks are good, but you have to be a longer term holder. You have to just hold it and view it as, a store hold of wealth that's going to pay you a dividend that over the long run is relatively stable. We're going to need iron, we're going to need steel, we're going to need copper, we're going to need these materials. No matter how technologically advanced we get, we're going to need these just raw resources. So view it as a long-term hold, and I think you're good to buy. It's going to adjust with inflation over time. It's going to pay you every quarter. You're going to generate income from it. And don't worry about the volatility. Don't worry about, don't worry about the volatility. Paper traders are involved. Is what it is. Good businesses, and you're right, they're very cheap right now. I like them. So, Apple, next week, I'm concerned. I have direct downside exposure after that earnings report. I have plenty of downside direct exposure to the S&P 500. Looks like we got up to this 4,000 level. Snapchat isn't very good. I have all of that exposure now after Apple reports its earnings, which I have laid out Apple specific cases for. Now we just add AT&T on top of that. I think it adds to my concern around the market right now. But it's not all doom and gloom. I'm not 100% short. I'm still mostly long. I have leveraged exposure via options to the downside, but I have long stocks that I like, and I have several positions that are in the 6 to 7% weighting that many would consider highly speculative. Jumia, for example, is my largest position. Disney is roughly the same size as Jumia. Both 7% positions, very large positions. I think Disney is very cheap, and I remember buying it at $80 a share during COVID before we hit the bottom, and I said, you know what? This stock is cheap. I'm gonna buy it, and I bought it. And right now you're basically getting Disney Plus for free. Disney Plus has been a tremendous success, and I think it's only just beginning. So Disney's content I prefer to Netflix. I'm not a fan of Netflix. Disney has much more diversified revenue streams. Their content is much more legacy. So I think Disney's a great buy. Similar to the mining companies that you mentioned before, they are, Disney's just a rock solid long-term company that right now is giving you a buying opportunity. There's others I think need to pull back that aren't priced well. Disney I happen to think is priced well. Some of the mining companies you mentioned I happen to think are priced well. Happy to stomach some volatility there. Happy to stomach some volatility in the largest online retailer in Africa, which is growing revenues 50%. I get it. The dollar's strong, is what it is. It's going to happen. I'm not going to try and market time that. Comfortable holding those types of longs. But I'm also kind of concerned about this just mega rally we've seen. It's like the market hears that Apple's not going to, or is going to slow hiring. Apple, Mr. Mega Cash in the Bank, Apple, going to slow hiring, and it dips and comes right back the next day. I mean, what happened? I thought we didn't believe Putin. All of a sudden, we're seeing Putin, bring the pipeline in Europe back to maintenance, and we forgot that everyone said they didn't trust Putin. So, and we rallied tremendously. So I think it's gotten a little too exuberant, and in the wrong stocks. If this were, a little bit of a ARK kind of rally, I wouldn't be concerned. I was long those types of companies, and they still haven't hit a new bottom since May 12th. We said that multiple times on this channel. But this has gotten broad. I think Apple is not going to beat its earnings. My assumption for that has been increased based on today's AT&T earnings. And therefore, I have to bet against it. That's just my opinion. So we'll see what happens. Something can come up on the snap call that, makes things go the other way. I didn't listen to the AT&T call. All I needed to hear was people are struggling to pay their phone bill. That's not good. That's not good for Apple, especially because they have a lot of people on that monthly subscription thing. So who knows what's going to happen, but I've laid out my assumptions. We'll see if they come to fruition. That's today's video, and until next time, peace out.